Lease or buy, very important topic um, from exam perspective as well as from the real life. When I say real life means the businesses. So sometimes we have to decide that whether we should, buy some equipment with, outfront, uh, upfront giving cash and just buy the asset, or sometimes we think that should be lease it, whichever is more economical. But before we begin with this idea, lease or buy, the first thing which you need to understand is that should the company invest at all? Because whether you buy it or whether you lease it, ultimately you have to pay the money. You have to invest in the asset. So the first thing is always, it's not about whether we should lease it or buy it. The first thing at all, in the first place, is that whether we should invest at all or not. So how do you find out that? For this purpose, you know that you calculated the NPVs, you calculated, the IRRs of different assets. You find out the present value of the future cash flows which are generated by that asset. So the concept here is that projects are appraised at what is called the weighted average cost of capital. So projects are appraised at, which means that all the projects, because these projects are for future, okay? So they are going to bring the future cash flows and you discount the cash flows. You find out the present value of the cash flows and you compare it, okay? The cost with the benefits. So the benefits will be the cash flows, and the cost, of course, is what you're going to give. And when you discount it on VAT, the discount rate. Sometimes you say 10%, 11%, the discount rate is 8%. And then on that 8% on 10% discount rate, you find out the discount factors from the present value table. So what is that discount rate, 8%, 10%? That is your WACC, weighted average cost of capital. And weighted average cost of capital means that the capital, it consists of equity, it consists of debt. So there is cost of equity, which means, and there is cost of debt. Cost of debt means the interest which you have to pay to the debt providers, to your creditors, to your lenders. And the cost of equity means the return, the expected return, which you should be giving to the providers of equity finance. And the average of that is called weighted average cost of capital, and that is going to be your discount rate. It says that projects are not matched to funds raised to finance the project. Sometimes actually it happens, but in most cases it does not. What does it mean, this sentence? This sentence says that the projects are not matched to the funds raised to finance the project, that you do not raise funds specifically for buying particular asset. You actually have a pool of asset over a period of time. And, from that pool, which is a mix of equity and debt, you keep on buying the assets. So therefore, you use the weighted average cost. Sometimes it does happen that you particularly borrow some money to finance a particular project, but that is a very rare case. So generally, it's not that, okay, this funding is for this asset, this funding is for this asset. It does not happen usually. In businesses, you've got a 20 million, 50 million pool of finance, maybe $100 million a pool of finance, which is your capital, some part equity, some part debt. And then from there, you will keep on buying the assets. All projects are appraised at the long-term average cost of capital, usually assumed to be weighted average cost of capital WACC. So it's a separate topic. We are not discussing calculation of WACC. Calculation of WACC will be done by calculation of, cost of debt, and then there are different types of debt: bank loan, preference shares, redeemable debt, irredeemable debt. Then cost of equity. Cost of equity, how do you calculate it? Using the CAPM model or using the dividend growth model? It's a long topic. It's not our debate here. We only understand here that all the projects for investment which you do, whether you lease them or you buy them, you have to discount the cash flows. And for the sake of discounting, you are using the discount rate, and that discount rate is actually your cost of capital. This is all you need to understand here. Now, what source of funds should be used? Now, this is the second question which comes to your mind. So first you say, okay, should I invest it or not? The answer comes in, yes, we should buy the asset. We need this asset for our operations, so we need to buy it. So if we have to buy it, then how do we get the funding? Are we going to lease it or are we going to buy it? Leasing is a form of borrowing, as the lease payments are a mix of interest and principal. Remember that leasing is a form of borrowing. You have two options. Either you need to buy an asset for $50,000. One option is that you go to a bank and you take $50,000 credit. You get that $50,000 cash into your account, and then you go to someone who is selling the asset, and you say, I want to buy this asset, and I'm giving you cash. They don't know that you have taken the cash from the bank on credit, whatever. You give them cash. So you say, I bought the asset on cash. I bought the asset on cash. But behind that thing, there is a bank credit. Okay. So this is one way. The alternative way of doing is that you don't go to a bank and borrow money. You don't do that. You say, okay, I go to the seller or supplier who sell the asset, and you say, I want to buy it from you and I want to lease it. I don't want to pay upfront. I will lease it. And tell me the payment plan. I will pay you in 4 years. So now this is called leasing the asset. So buying the asset or leasing the asset. So whether you are leasing the asset, it is also a form of borrowing, because you are going to pay them in the next, instead of paying to the bank, instead of returning the credit to the bank in 4 years, you will pay 4 years to this leasing company or to the supplier who has leased you the asset. And of course, the payments include the principal and the interest, the same amount. I mean, the same composition of principal and interest. So for me, whether I buy or whether I lease, there is some credit coming up, either from the bank or from the supplier. Okay. So what you need to do, that should you buy it or should you lease it, which means that should I take a $50,000 from the bank as a bank loan and buy asset on cash, or should I directly lease the asset? So I need to see that which credit is cheaper for me, because bank is giving their own interest rate, maybe 8%, 10%, 12%, I don't know. Then this supplier who is leasing me the asset, he has its own interest rate, 8, 10, 12%, I don't know. So I have to compare. So if I take a credit from the bank and then purchase asset on cash and return back my credit, is it cheaper? Or directly I just ignore the bank and directly lease the asset and start paying the lease payments to the supplier? Will that be cheaper? So whichever is cheaper, you have to take that option. Okay. So this is, therefore, choose between whether borrowing or leasing is cheaper. So we need to compare them. How do we compare them? We'll see one very simple example. A company borrows $10,000 at 8% interest, and it will repay the loan at the interest rate over 3 years in equal installments. So what is very important here to understand is these three things you have to pay attention. $10,000 is the amount, 8% in the interest rate, return period is 3 years, and it has to be equal installments. So how much is your annual installment is going to be? This is the first question. And we have done that thing before as well. We know that if you take a $10,000 credit and you want to return back in equal installments over 3 years at 8%, how do we calculate our annual installment amount? So it will always be, the formula is the loan amount which you are taking, and you divide it with the annuity factor of 8% at 3 years. So you will open up your annuity factor table, go to the table for 3 years at 8%, whatever will be the factor, just divide loan amount with that, and that is going to be your annual amount payment. So the annual repayments needed are given by amount borrowed divided by 3 years 8% factor. 3 years 8% factor from the table is 2.577. So 3880. So it means that you have to pay 3,880 times 3. Okay, three amounts you have to pay. How much it makes? Let's see, a total 3880. Let's see the calculator. 3880, just for the sake of interest. So I'm going to pay something like 11,640 total. And so it means that I took a loan of 10,000. So actually I'm paying 1640 as interest. If you consider interest amount is going to be 1640. So every time when you pay 3880, it will include principal. A part of the principal you are returning back, and some interest is included. So it includes interest, it includes the principal. Okay, both. If you want to check this number, 3 annual payments of 3880. So this is how it will work. Your initial borrowed amount is $10,000. 8% interest means 800. So 10,000 plus 800 minus this 3880, which you will pay at the end of year one. Your outstanding principal is 6920. Your outstanding loan is 6980. Okay. So let me just say 10,000 was my initial loan, and my ending loan at the end of year one is minus 6920. That is 3080. So although that I have paid 3080, I have paid 3880, but my loan has reduced by 3080 because the remaining amount is interest. So I can say that when I paid this 3880, it includes 3080 for principal and 800 was interest actually. Yeah, this was the interest. Okay, so in year two, this 6920 comes here, and then on that 6920, 8% interest is calculated. And then again, you paid 3880. Your remaining loan is 3593. This becomes the opening amount in year three. You add up your 8% interest and you subtract the payment, and it is nil. Okay, so this is just a table showing that calculation that we calculated here 3880. So how did it work? So it is just a proof that, okay, 3880 is my payment. Now a question, simple lease or buy question, very simple question without any tax impact or something. It says that a company has decided to invest in a machine that would cost $20,000 to buy outright, or which could be leased at $5,000 per year for 5 years. So you have two options. Either you pay $20,000 today in cash, or you pay $5,000 over a period of 5 years. So it means that you end up paying $25,000. But this $25,000 is over a period of 5 years. So you are going to pay 5K, 5K, 5K in next 5 years. And you just have to find out the present values and then compare that. If I pay today, it is 20,000. This is the value today. But if I pay over a period of 5 years, that is going to be 25. But when I find out the present value of all these 5K, 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 how much it is going to be, you compare these two numbers. That's a very simple logic. Okay, nothing complicated here. That's why I call it simple lease or buy question. So company's post-tax cost of borrowing is 10%, which means your WACC, your cost of capital, your discount rate is 10%. So 20,000 is clear. I can buy now. Let's see if I have to lease it by paying 5,000 per year. We just find out the present value of those 5 payments. Now remember that if you have to pay 5,000, a fixed amount for a fixed period of time, you call it an annuity. What is annuity? Annuity means a fixed amount received or paid for a fixed period of time. So find out the annuity factor for 5 years at 10%, how much it is. So the annuity factor of 5,000 at 5 years, annuity factor of 10% at 5 years is 3.791. You multiply it with 5,000. So it means that all those 5 payments of 5K each, year 1, 2, 3, 4, 5, their present value comes out to be 18,955. So if I buy today, I have to pay 20,000. If I get it on lease and then I start paying 5K, 5K, so the present values of all these numbers together is only 18,000. Lease or buy? Lease or buy? Of course, lease. Leasing is cheap here in this case, because what you will be paying in 5 years, the present value of all those two amounts, although it looks bigger, it looks 25,000, but in reality, the present value is just 18,955. So you will save actually $1,045. So leasing is therefore cheaper, as it is equivalent to having to pay only a smaller amount. Now, that was a very simple question. I don't think that you would be getting this type of question in exam, but this is to build up your understanding. Now, if we do one more question and add some additional information, let's see then. A machine would cost $20,000 to buy, because in this case, we did not include the tax impact. Remember that if you purchase the machinery, if you buy the machinery, you would depreciate it, and that depreciation will go into your income statement as expense, and that would reduce your profitability, reduce your profit, and therefore it will your tax will be reduced. So we say that if the depreciation, it brings you the tax benefit because your tax is reduced. Okay, this is one complication. And if I buy this thing, if I don't buy it, and if I lease it, then this 5,000 will go into my P&L as my lease rental, which is expense, and that also brings down my tax benefit, my tax liability. So there is some tax benefit here. If I buy it, I have a tax benefit. If I lease it, I have a tax benefit. In both cases, I have the tax benefit. But the value of the tax benefit amount will be different, because here the tax benefit is on the depreciation. Here the tax benefit is on that lease rental. So sometimes we need to compare, or how to say, consider the tax benefits as well. Okay, so we'll do one question here. So machine would, oh, okay. So sorry, this is not a new question. This is the same question. It's the same previous question, but just an alternative calculation. So what we did before, we said that if this is $20,000 straight upfront fee, or otherwise we can get 5,000 of 5 payments. We found out the present value of this 5 years annuity, and we said it is 18,955, and we said that because leasing is cheaper, so we should go for leasing. This is the answer for this question. This next screen is actually the same question but an alternative answer, which means a second way of seeing it. Before, you were comparing it with this amount, leases, and you found out the present value of lease payments. Now we do it with another way, just to prove. It says that a machine would cost $20,000 to buy outright, or could be leased at 5,000 per year. So your lease annual rental is 5,000. Okay. So the another option of doing it is that we say, if you borrow the money, so you decide that this $20,000 is not with you, you have to go and you have to borrow the money. So borrowing 20,000 has a post-tax cost of debt of 10% to repay this over 5 years. So if you borrow the money from the bank at 10%, so you decide, you divide it with, you find out the five equal installment. You say that, okay, if I have to borrow 20,000 from a bank and I borrow at 10%, and for 5 years. So you find out the 5 years annuity factor, you divide 20,000, you say to the bank you have to pay 5276. So this is the five equal installments. If I borrow money from bank, I have to pay 5,276 to the bank, whereas the lease payments were only 5,000. Now lease payments, we don't calculate the present value. See, in one case we calculate the leases value of leasing and compared it with 20,000. Now I say, if I borrow from the bank, how much annual payment I have to pay? 5,200. My supplier who is giving me lease, he's offering me 5,000. So leasing is better. So whether you check it this way or that way, you make your calculation on borrowing, or you make your calculation on leasing, whatever you do. But when you compare, leasing is cheaper. Okay. Before also we concluded that leasing is cheaper. Now you might be thinking that, why do I borrow? I've got my own money in the bank. I've got cash in my pocket. So if I have my own money in my bank, then is this thing still valid? I mean, do we need to do this calculation? Yes, you need to do. Because even if you have money with you, It's not for free. It has a cost, 10%. You can put the money in the bank, and you can earn some interest. So don't think like, if I have my own money. You Nobody has their own money. It's not about your own money. Even if it is your own money, it has a cost. So you will always assume that if I have to purchase something, never say that I will open up my drawer and I'll take out 20,000 and I will buy something. It does not happen. Because even if you have the money with you, still it has a cost. It is not free. So ignore it for a moment, and you will always consider, either I'm borrowing or I'm leasing. If you borrow, you have to pay 5,000 to the bank. If you lease, you have to pay 5,000 to the leasing. So that's why leasing is a better option. Okay. So in any case, it was a simple example. We did our calculation from two aspects, from both sides, but in the end, it's the same question, which was a very simple question. Yes, we do have some other questions with some other complications, like taxation, when tax comes in. So when tax comes in, like I told you, that there is going to be some tax burden, there is going to be some tax benefit, and we need to consider that. Taxation adds the following complication. If the asset is bought, then the owner will enjoy capital allowances. Capital allowances is depreciation. Okay. So the word, because depreciation is not allowed under the tax regime, because depreciation is something which you decide, 10, 20, 30, 40%. Depreciation is not allowed. In tax, we call it capital allowance. Capital allowance is also a depreciation, but that depreciation which is allowed by the tax department. Okay. So capital allowance is the same term. It's a different terminology for the same thing. It says that you can depreciate asset, but when they tell us that how much allowance they are giving us, so we call it capital allowance. So you will have capital allowances, which means you will have depreciation, and that depreciation will reduce profit, will reduce tax. So you will have some tax benefit on capital allowances. We call it tax benefit on capital allowances. Okay. The second option is that if you lease the asset, then whatever lease rental, $5,000 you will pay, that $5,000 you can take into your profit and loss account. Again, your profits will reduce, your tax expense will reduce. So you get some tax benefit. And you need to compare, well, while making the calculations, you need to compare these two. Okay. So let's see here a question. An asset costs $100,000 at the start of an accounting period and will receive tax allowance on a 25% straight line basis. So we use the word at the start of an accounting period so that we can say that full year depreciation or full year capital allowance we can charge, just to make calculations simple. And will receive tax allowance on a 25%. Tax allowance on 25% means that you can depreciate asset at 25%. Okay. On straight line basis, it can be sold in 4 years for 10,000. Now this is a second complication, that you will straight line basis means that you will depreciate it 25%, 25%, 25%, and you make it zero. But then you sell it for $10,000, okay, which is a residual value. So this also will have a tax impact. This also will have a tax impact. So this is the option. Alternatively, it can be leased for 4 years at $30,000 per year, payable in advance, in advance, which means that right from day one, the moment, because remember that lease payments could be in arrears. Arrears means that your first lease payment will become due at the end of year one. But when you say in advance, it means that you will make first payment today, and first payment at and the and the second payment at the end of the year. So you are actually having two payments, one here and one here. So advance payments, we need to do calculation, or we need to provide calculation for both scenarios. Post-tax cost of capital is 10% tax. Rate is that cost of capital, WACC or discount rate is 10%. Tax is 30%. And tax is paid 1 year after the end of accounting period. You don't pay tax in the same year. You are paying tax in the next year. I'm sure you people are quite familiar with this scenario or this type of scenarios, because you are familiar with the calculation of net present value tables and NPVs, calculating, finding out the cash flows and paying tax in the next year. Sometime you pay tax in the same year, sometime you pay tax 1 year later. Let's first make the table for, or working for, buying and selling. Okay. So purchasing. If I purchase the asset, what will happen? This is the table you need to prepare. So if you purchase the asset, you will pay $100,000 in time zero, year zero. It is a cash outflow. But then what is the 7,500? This is actually tax allowable depreciation allowance. So this is your tax benefit you are getting. How do I calculate this 7,500? They told you that the value of asset is 100,000 and you get 25% straight line basis. So 25% is my depreciation, which means that every year I will take $25,000 in my depreciation as a depreciation expense. When this depreciation expense goes to your income statement, on 25,000, 30% is your tax rate. So when you take an amount of 25,000, you don't make a saving of 25,000. What is the tax rate? That is your saving. Okay. So 25,000 into 30% is 7,500. Any expense which you take to your income statement, to your profit and loss account, it gives you a tax benefit, which is the tax rate multiplied by the expense. Let me give you an example. Okay. Let's suppose that your sales, let's suppose, I'll just give you a quick answer, are 100 and your costs are, I don't know, $50. Okay. So you come out with a profit of $50. Your tax is 30%. So this is 50. So tax rate is 30%. So 30% of 50 is 15 is your tax. Okay. And profit after tax is 35. Now imagine that this is 100 same. This is 50 like before. But you introduce another expense. You had another expense. You make another expense. Maybe you paid rent or something. And that additional expense comes out to be $10. So if additional expense comes out to be $10, then my profit will be now 40. Okay. And if my profit is 40, so tax 30% of 40 is $12. And my profit after tax is 28. Now, two things I want you to learn here. One, if you see that how much is the tax benefit? Here your tax was $15. Now your tax is $12. So there is a decrease in tax of $3. Your tax liability decreases by $3. So you can say that my tax liability decreases by $3, or you can say that I got a tax benefit of $3. Right? If your liability decreases, it's a benefit. So you got a tax benefit of $3. How did $3 come up? This $3 was that this was the expense. This was the expense which you introduced. This expense you introduced, so $10 multiplied by your tax rate, 30%. So that's how you get $3. Okay, that's how you got $3. So your tax benefit will always be that additional expense which you bring to your P&L multiplied by the tax rate. You cannot say that if my expense is $10, I will get a tax benefit of $10. Tax benefit is not $10. Tax benefit is 30%. 30% of that particular expense. Okay. This was first lesson you need to learn. A second lesson, which is actually not needed here, but you should remember that although you have increased your expense by $10, if you pay attention now, that you have increased your expense by $10. Yeah, $10 additional expense. Did your final profit also decrease by $10? No, your final profit only decreased by $7. I mean, you said, oh, I've got a $10 additional expense. So is it going to impact my final profitability by $10? Answer is no, because you got $3 tax benefit. That although the expense was increased by $10, but then you get a $3 tax benefit. So net profitability is impacted only by $7, which we call post-tax impact. Your post-tax impact on profitability is after deducting the tax benefit. Okay. So this is something separate. What we need to understand that anytime you bring in an expense into your profit and loss account, you get tax benefit. So if I bring in If I bring in this depreciation, I've got $100,000 of asset, and this asset has a 25% capital allowance, which means that in my profit and loss account, 25,000 of depreciation will be written. Not all of that will be tax benefit, but 30% of that will be tax benefit, and that is 75,000. And you get it in year one, in year two, and in year three. And why I'm putting it, although the depreciation belongs into the same year, but they say that tax must be paid 1 year later. So the year one tax you pay in year two, in year two tax you pay in year three. And the rule is that if you pay the tax 1 year later, then the tax benefit also be claimed 1 year later. Okay, so your tax liability will arise, the year one tax, the tax which is due to the profitability of year one, you will pay it in year two. And therefore, the benefits will also be associated in year two. So here I'm not showing the tax benefit, the tax expenses, because we don't know how much revenue is here. So we are not talking about tax liability. We are only considering the tax benefits here. So the tax benefit comes in 7,500 in year two. This is actually because of year one. And year two amount appears in year three amount appears in year four, and year four amount goes in year five. But if you pay attention, here the amount is different. Here the amount comes out to be 4,500, 4,500. Why it is decreased? Because you are getting this $10,000. You are selling the asset for $10,000 on which you have to pay the tax. So your expense actually 25,000. On that expense, you will multiply it with 30%, and you get a tax benefit of 75. But then you are selling the asset for $10,000, and here you have to pay the tax. This is your tax liability because you already depreciated 25, 25, 25. Your asset becomes zero. A value of zero asset you are selling for 10,000, so that's a gain. That's a gain on disposal. And the gain on disposal, you have to pay the tax at 30%, and that is 3,000. Okay. So this is the benefit. This is the tax which you have to pay. Net amount is 4,500. And that 4,500 appears in the last year because they told us that in year four you will sell it. So the tax impact of year four will be paid in year five. So this has changed. Now we come back to the cash flows. This is 100,075. This one you made total in year four cash flows and year five cash flows. Make total, find out the 10% discount rates, multiply them, find out the present value of cash flows from year one to year five, and then find out the present value of purchasing. So if you purchase this equipment, it costs you 73,245 because this is your outflow and these are your inflows. So it is actually a cost. This is actually a negative, like a cost. So we say that the real cost, see, although you have paid $100,000 today, but is it going to be a cost of $100,000? No, because I'm getting some tax benefit. Remember, I told you that if you pay an additional expense of $10, the real cost to you was $7 because you were getting some tax benefit. You were getting some tax benefits, 30%, 30%, and so on. And then what happened that the tax benefits happened in the future years. So whatever benefits were there, so you got a benefit of this, but because this benefit happens in future, you have to discount it. So the present value of the benefit is only 5,600. The present value of this benefit is only 6,100. The present value of this benefit is only 11,900. So two things are happening. One, the tax benefits we are getting, and second, the tax benefits we are getting in the future. So we discount them. So the present value we finally conclude is 73,000. Although from your bank account, 100,000 will go out as cash. But when you give this cash, you start getting benefits in future in form of the tax savings. And the sum total of that is 73. So the real cost of buying this asset will be $73,425. Then we will see our calculation for leasing. If you do leases, if you buy this equipment on lease, then what happens? Then you will not get this capital allowance because the asset does not belong to you and you will not depreciate. You will only consider the lease payment, the lease rental as your expense. And that would be a bit more simple. So we say that alternatively, it can be leased for a 4-year period at $30,000 per year, payable in advance. You have to pay in advance, okay? Um, you will consider this 30,000 straight as your expense, rental expense in profit and loss account. There is no capital allowances or depreciation because asset does not belong to you. So the table looks like this. And when we say that payable in advance, it has an impact, okay? Payable in advance has an impact because you've got 4 years, 4 payments, and you pay attention, you are finishing in year 3. Why you are finishing in year 3? Because what happens that you make one payment in advance, which is on year 0. Then in year 1, you make one payment. In year 2, you make another, and the end of year 3. So what is happening that this is the beginning of year 1 and this is the ending of year 1. So you are making 2 payments in first 365 days, you make 2 payments. One today, one on 1st January, one on 31st of December. This is 31st of December year 1, 31st of December year 2, 31st of December year 3, and one payment here. And we know that the present value factor for time 0 is always 1. So here you take one factor. In this years, what happened? That then you get what? When you introduce this $30,000 as expense into your profit and loss account, I told you that whenever you bring an expense, you multiply it with the tax rate, and that is your tax saving because your tax will decrease by $9,000. And this $9,000 this is a tax benefit which you receive 1 year later. So for the year 1, you get it here, then you get here, then you get here, and finally you get here. So this time scale goes up to discounting to year 5. Okay. And then you do nothing is 30,000. So what is happening in year 1? The amount remains same. In year 2, you've got 30,000 of lease payment, you've got 9,000 of tax benefit. Your net cash outflow is 21,000. Here 21,000. And these are the cash outflows. These all are negative numbers. These two are the positive numbers because here you don't make any lease payment, but you do get a tax benefit. So these are the two positive numbers coming up. Once you draw this table, all you need to do is 10% factor for year 0, which is 1, year 1 factor, year 2, year 3, year 4, year Y factors. And you multiply them with the factors, you find out the present value, and you get the number. Present value of leasing is 78,651. Now, remember that how much you are paying? You might be thinking that, oh, I have to pay 30,000 times 4. So from my bank account, 120,000 will go out. Yes, 120,000 will go out, but then you are getting these tax benefit. So therefore your cost is less. You might be thinking that if you do mathematics, oh, 120,000 will go out and 9 times 4, 36,000 I'm receiving as tax benefit. So the difference between 120 and 36 is 84,000. So my true cost should be 84,000 if you do maths, but this is not maths, this is finance. And you say 84,000, but this is 78. Where is the difference? The difference is that these amounts are not happening on one day. These amounts are happening in different years and they have different discount rates. So when you find out the present value, for example, you consider 9 times 4, 9,000 times 4, 36,000. But you see the real benefit is 9,000 is only 6,000. This is 9,000 is only 5,000. So this number 78, simple maths will bring 84. A person who does not know finance would say, I purchased the asset for 120,000 and then I get tax benefits of 36,000, my net cost should be 84. But when you calculate 84, you are ignoring the time value of money. When you bring in the time value of money, then it is a different number. So 78,000. So if I lease the asset, it cost me 78,651. If I had purchased the asset, if I had bought the asset, it would have cost me 73,000. So we can say that comparison of buying and leasing, present value of buying 73,425, present value of leasing 78,651. What should we do? Buying is a cheaper option. Buy the asset. Don't lease the asset, because here leasing looks like an expensive option. And then we said that income from the project can be ignored. Yeah, because we did not, because this was an asset. Okay. So this asset could have brought you some revenues, it had some cost. We ignored all of them. Because whether you lease the asset or whether you buy the asset, that income and those costs, I mean, the project related, the cost will remain the same. The real cash flows for this project probably $2 million, because the asset will work and it will produce something and it will bring in a revenue of $2 million or whatever. We are ignoring it. We are not considering it. Actually, we don't have information about it as well, because whether you lease it or you buy it, those calculations will remain same. Revenues will not change. Okay. So we just ignore them. Here we are only comparing the costs which are related to the financing decision. Its operating cash flows will be a different decision. Operating cash flows will remain same. Here I'm comparing the cost of either leasing or buying. So the financing cost I'm calculating. So buying is a cheaper option. We will not lease this asset. We will buy the asset.